Well, hello, ladies and gentlemen. I hope you've recharged your glasses up to your level of blood caffeine and or blood sugar and are raring to go for our next session. My name is Mark Wallace. I'm the Chief Executive of Total Politics Group, which owns and publishes Conservative Home. It's fantastic to see all of you here today, to see such a engaging series of discussions on such a vitally important economic, social and political topic. Of course, there are a number of people who, without whom this event simply wouldn't be possible. That includes you, the audience in the room and at home. It includes the great editorial team at Conservative Home, our fantastic events team, all of our speakers, but it also includes our partners. And that, of course, includes Hargreaves Lansdown, who have very kindly helped to make today's event possible. And it falls to me to introduce, and I hope you'll join me in giving a warm welcome to their CEO, Chris Hill.
Well, good morning. I'm Chris Hill, the Chief Executive of Hargreaves Lansdown. We are delighted to sponsor this conference from Conservative Home because all too often these issues of savings, pensions and investments are not at the forefront of political debate. But they are essential as we aim to build our financial resilience as individuals and support ourselves in later life. In turn, our savings and investments impact how much we can consume in our economy and how we can support economic growth through our investment. This conference should shine a light on how the government can support us all in reaching these aims. And looking back over the last 5 or 6 years, there hasn't exactly been a quiet moment when it comes to savings and investments. As we came out of COVID lockdowns in 2021, it was clear that people would be readdressing their financial resilience. And we wanted to establish the full picture of the nation's financial health. And our starting point was what we know best, financial planning. And we developed resources around a 5 to Thrive framework. Control your debt, protect your family, save a penny for a rainy day, plan for later life, and invest to make more of your money. This wasn't rocket science. It's simply the 5 areas one of our financial planners would work through with you if you were paying for advice. And we wanted to share this way of thinking more widely. Using this framework, we then developed our Savings and Resilience Barometer with Oxford Economics to zoom out and take in the broader picture. Looking at drivers of both short and long-term financial resilience, we asked the question, had financial resilience across these 5 pillars improved or got worse in lockdown? The results, which aren't a surprise anymore, showed that actually most had left the lockdown period in better financial health than they started, not least because of the support the government had put in place at that time. But then things changed very rapidly, and in the cost of living crisis, our barometer shows us very clearly that the bottom half of households by income are now really suffering, with their finances in a worse state than they were before the pandemic. This has got both short and long-term scarring impacts, with people experiencing money worries today and being less able to put aside as much for later life as they had done before. In these circumstances, we naturally thought about how best we can support our clients. And that's where another one of our learnings from lockdown came to the fore. One of the unexpected impacts of lockdown was that many people also had time as well as money to spare, which meant that many started to think more deeply about their financial planning and how best to save and invest for the future. People also embraced digital interaction. As a result, many started investing for the first time, with HL alone welcoming 500,000 new clients. But some choices being made looked like speculation as opposed to long-term investment. For example, they were excited by the opportunities investing in just one sector, such as airlines or hospitality. Well, short-term speculation with sector-specific concentration are not key attributes of long-term investment success. So we developed a communication strategy to encourage better investing. HL has always focused on getting the best information to clients. We look to build knowledge, grow confidence, and develop engagement. So we started to segment our client base, finding those who had undiversified portfolios and targeting them with information with titles such as Invest Like Buffett, and educating about long-term ownership and the power of compounding. We found that these more specific nudges drove far higher engagement and led to improvements in the diversification of their investments. In turn, this will lead to improved long-term outcomes for these aspirational people who are new to the world of investing. Now, why, you may wonder, am I telling you this tale? Why is it relevant now to this policy audience? Well, there are several points. Firstly, communication to clients has transformed. So much more can be achieved with layering information to clients through a digital relationship, rather than giving you a data dump of every possible piece of information. We need to change the rules to make it easier for firms to provide the right information at the right time. In many cases, this will simply mean the removal of information that firms know to be irrelevant. Secondly, personalized messages connect with more people. We are delighted to see the government support a review of the advice guidance boundary in their Edinburgh reforms. This is critical to allow firms like HL to improve the relevance of their information to clients. And thirdly, the data revolution is happening all around us. Let's make sure that the UK is at the forefront of supporting people to manage their personal finances better, to ensure that they are more efficient and effective and more money is freed up to invest and spend in our economy. So for me, the future is clear. Let's make personal finances simple for people. Let's strip away information people don't need immediately so we can guide them to better outcomes over time. Let's simplify financial choices made unnecessarily complex by the tax system. For example, you can save into more than one pension and keep the same tax-free benefits. But this gets complicated when it comes to saving into more than one ISA of the same type. Let's free up financial firms to use what they know about their clients to drive better outcomes. The data and AI revolution is up and running. If we don't start personalizing financial information to make it easier for consumers to make choices, someone else will. At best, this may be unregulated finfluencers. At worst, scammers. Let's improve stability in products. I don't need to tell you how many times tweaks have been made to how you can draw down your investments in retirement. If we want people to save for the long term, they need to know that the goalposts won't shift every time there's a budget. We need cross-party consensus of how wealth is treated if we are to encourage more to save for the long term. People now have personal responsibility for having enough money to leave the world of work. Let's empower them to take control by ensuring they can have the contributions from their employer into a pension of their choice, rather than asking them to change pension provider each time they change jobs. After all, we don't ask a new employee to change the bank account they use just because they've changed jobs. And let's make it easier for people to invest directly in things that will power up the UK economy. Whether that's improving the prospectus regime so that more companies choosing to list in the UK are available to retail investors when first raising capital, or allowing those with investments in ISAs to access the opportunities in long-term asset funds. Now, I hope that that short rundown provokes debate, rather than puts off the two ministers we've got here today to speak. In some respects, they have the toughest job, transforming our savings and investment culture, but there is, without doubt, the opportunity to do just that. It gives me great pleasure to now hand over to the Economic Secretary to the Treasury, Andrew Griffith. Minister, over to you. Thank you.
Coming back on the stage? Yes. Thank you, Chris. Thank you. Thank you. Thank you. Thank you very much, Chris. I'm delighted to be there. We now understand the penchant in SW1 for 5-point plans. It was clearly your 5 to thrive what started it. My colleague for the brilliant Minister for Pensions is speaking later, so I'm going to, although we're perfectly joined up, I will focus my remarks on tax, on the landscape for savings and investments, and the financial regulations and culture more generally. We live in an era where across the West, societies are struggling with ageing populations and finite budgets. And to be frank, you'd be pretty bold to assume that was going to change anytime soon. Supporting private investors and savers helps to free up limited state resources to help those who have no choice. So this government is on the side of those who seek to provide for themselves. One of the reasons that we're so focused on inflation, one of the Prime Minister's 5 to thrive this year, is that because it can undermine the whole incentives to save or to invest. And I'm glad the OBR predicts that we're on track to achieve that halving this year. And although there's certainly more to do, please don't buy into the myth that we're not in the business of cutting taxes. I didn't go into politics to raise taxes. I'm sure that's true of the Chancellor and the Prime Minister. And to give you a proof point, since 2010, we've nearly doubled the personal allowance to £12,570, cutting the tax of an average basic rate taxpayer by more than £1,200 a year. I said that this is an apposite time because in financial services, taking back control of our rulebook has given the UK a unique opportunity to do things differently. This government has a vision for the UK as an enterprise nation built on low taxes, reward for risk, great access to capital, and smarter regulations. And the Financial Services and Markets Bill gives us the architecture to do just that. And it's approaching its very final lap in Parliament right now. Our Edinburgh reforms take that ambition forward for the UK to be the world's most innovative and competitive and open global financial centre. And at its heart is a new duty on regulators, the regulators that impact Hargreaves Lansdown and others, to promote growth and international competitiveness. That is a first in the regulatory landscape. Of course, it involves rebalancing risk. And as someone who spent the best part of 3 decades working in the private sector, including in FTSE 100 companies, I know the importance of taking calculated risks. Remember what happened during COVID, when the government took bold and deliberate, a little bit unusual, risks on the vaccine programme. Because risk is the lifeblood of the enterprising economy that we seek. And we need a culture change to be positive about taking risk, to celebrate risk takers, even if a side effect is that they become wealthier as a result, and not beat ourselves up too much about the failures that always happen on the road to success. Some say, well, what about 2008? Isn't it risky to reform? To them, I say 2 things. The first is that 2008 was a genuinely different era. A lot has changed in the world since then. 2008 was before the first iPad was invented, before the British people chose to seek a new relationship with Brussels, and a decade further back before the world became even more competitive. It's perfectly possible to learn sensible lessons from the past without fully driving in a rearview mirror. The second thing I'd say is that the greatest risk is not reforming. Lower returns for investors, poorer pensions in retirement, and a weaker economy that doesn't get the investment that it seeks. So those are the risks if we don't change. This is, Mark, a Conservative home event, so let me talk about politics for a moment. There is a vast philosophical difference between this Conservative government and other parties on the role of markets. Don't let anyone convince you that that gulf is not there. Just last week in Parliament, I debated a score of opposition MPs wanting to nationalise industries, introduce rent controls and an excess profits tax, repeal trade union laws and cap food prices. It was like a greatest hits tape. Now that's what I call Socialism 24. That's probably showing my age a little bit. There are real fault lines too about our approach to financial services regulation. The belief in the intrinsic moral virtue of markets, the appetite and toleration for taking risk versus protecting consumers from themselves, and that the answer to every question can't just be more rules and more regulators. You can see that divide in the left's virtue signalling, town hall and student union campaigns for divestment. I've publicly called out before those in the investment world who would boycott British defence companies whose products are helping defend Ukraine. Some so-called ESG funds persist in doing that, even now. Well, my friends, there's nothing sustainable about a world in which brute force overcomes a rules-based order. By contrast to those who would tell others what to do, there are huge benefits to having more individuals owning shares. Individual investors contribute to the depth and breadth of markets, often in ways that index-hugging institutions do not. They generally have a long-term investment horizon and tend to hold shares for extended periods, stabilizing markets during times of volatility. Americans may not understand football, but they have a much stronger culture of personal investing and knowing what's in your portfolio. In the US, you find people talking about their 401k or individual retirement accounts at a bar or at a barbecue in a way that's simply unimaginable here. And retail investing is good for society too, fostering a greater understanding of the role of business and investment. I always say if the activists gluing their hands to the roads knew what was in their trust funds, they might be a little bit more vested in the economy. So as the responsible minister, I agree with those who say we need to make equities sexy again. So we are simplifying the documents that firms need to list, the prospectuses that Chris talked about. When I worked in the city 20 years ago, 48 pages was a long prospectus. Now they run to multiple volumes, which no one other than the lawyers read. We're going to review how investors can have easier and cheaper access to advice, and update paper-based share registers for a digital age, giving individuals more of a say. So let me be clear, come back, Sid. We're going to make it easier and better for you. Another way we'll do that is by looking again at the structure and rules of ISAs. This was something the Chancellor announced in the spring budget. I hope that many of you here will contribute to that work. ISAs are a tremendous innovation, a safe space from the predations of governments over time, no income, capital gains or inheritance tax, in fact no need to even report them on your tax return. And because they're limited to only 20,000 a year, they're quite progressive. They're for the many, the mass market, for middle Britain. It's pretty rare that a piece of government architecture like this stands the test of time. So be in no doubt they are here to stay, but I'd like to make them even better. In recent years, the number of people taking out an ISA has fallen, and a high proportion are invested only in cash, when for many savers that may not be the best answer. In fact, I've seen research which said fewer than half of Britons even know that a stocks and shares ISA exists. So to conclude, a new financial services bill, the Edinburgh reforms, a fresh approach freed from the old rulebook, a new attitude to risk and a pivot to growth and international competitiveness. Let me say one final thing. To those of you who are investors or who work in our vital financial services sector, thank you. Thank you for creating the wealth, for taking the risks, and for doing so here in the UK. We never forget that you have a choice, not just where to locate, but where to commit your capital and your time. And be assured that this government will always be on your side. Thank you.
Thank you very much, Andrew. Now, I am vested with the tyrannical power of getting to ask some questions of my own before we then throw the discussion over to the audience. We will try and bring in as many audience questions as possible. I was really struck, Minister, by during Chris Hill's remarks and then your own about the way that each of you mentioned the rapid pace of technological change. And obviously, you know this from your, we see this in politics, we see this in the type of business in the media sector that, say, Conservative Home is, or indeed Sky, where you yourself were CFO. We see it in HL and others with the pace of fintech innovation. And yet, what also so much of this comes down to, in terms of the advice that you were talking about, the political approach, consumer advice, and so on, is really centuries and centuries old. And those principles of conservatism, when Burke talked about the social contract being an alliance between those who went before, those who've died and maybe prepared for their own families' futures, the living in terms of their own efforts, and those yet to be born, how we prepare for our own retirement, how we save for our own family's future, how we invest for businesses. How do you see, or do you see, challenges to conservative, small c conservative principles of economic management arising from the technological change we're currently seeing in the world?
I think, look, I mean, I tend to always look at the opportunity. So you're absolutely right about the very radical changes in technology. They always say, what is it, the pace of change will never be as slow again, right? So it keeps getting faster. The UK's got a great story in this domain. We were pioneers in open banking. Many of the people on the previous panel talked about the apps that they use. That's very empowering. That's very democratic. I want to see open banking locked in to be more sustainable. It was originally an intervention that came out of the competition regulator. We're now going to put that on a permanent footing and then use that as a foundation to build, again, into new domains, pensions, people's ability to invest, having that democratic empowerment. The same thing with share registers. Share registers, I mean, somewhat astonishingly when I got here, are still heavily focused on bits of paper. I mean, there are literally, bits of papers in safes. It's the equivalent of those old fax machines in the NHS. We have to move on from that, because one of the big challenges in the financial sector is how disintermediated people feel. They don't feel that they've got agency over the decisions. The impulse is there. People are engaging in speculative investment in things like crypto assets. I want to, again, rather than not engage in that, I want to bring them into a sensible regulatory domain so people can get that balance between sensible protections, but also definitely not closing our door to the radical innovation that's happening.
And how does that relate to a certain extent, what we're talking about is just the same as, say, medical regulation with regard to, say, what we saw in the pandemic, with the UK choosing to open up routes to innovation for vaccines development and so on. So much of this comes down to our regulatory attitude. What is our view on, say, the precautionary principle? What's our view on competition and divergence compared to compliance? Obviously, we've seen a really big debate about that in services, among other areas, with regard to the Windsor framework. What's your view on what should be different and distinctive about the UK's attitude to regulation?
There's a few things. I do think, and I speak every time I speak, I talk about risk. I mean, essentially, these are not discussions that are healthy to have at the extremity, right? No one's trying to burn every regulation, diverge for divergence sake, anything like that at one extreme. But there's also, in the system, there's a lot of hidden risk, right? I talked about it, the hidden risk that your investments don't perform, that you get a worse outcome in retirement or in your old age because we're not generating the performance. The risk to the economy that this great productive cyclotron of capital, is operating at a much slower speed than in other places in the world. So what we are trying to do is to recalibrate some of that risk. There's no doubt about that, and that manifests itself both in what are the overall duties of regulators. If you interpret them at one extreme, you're always going to be what they call risk-off, right? Always seek to perhaps preserve capital at all costs, not take a risk, and there's a lot of incentives in the system to do that. There's incentives if you're a civil servant because you're on a, final salary pension scheme. You just all you want to do is just sit there for as long as possible and make sure that you can retire without any black marks against your name. There are risks on the regulators. No one enjoys being grilled for 2.5 hours in front of the Public Accounts Committee or the Treasury Select Committee. So there's a risk there. And there's duties that we've put in financial regulation, particularly since 2008, which is, I say, is actually quite a long time ago now. It's coming up for almost a generation ago. The world's fact pattern is very different. That, again, put in a different layer of mechanisms to try and reduce risk. So all one's trying to do is just move that pendulum a little bit more into balance than at one particular extremity because of all the good things it will do for society. How do we do that? One is the new duty to balance consumer protection, financial stability with the growth of the economy and maintaining ourselves as internationally competitive. That's about a balance. It's not about getting rid of old duties or considerations. It's about adding one that just puts a little bit more balance on that pendulum. It's also about the conduct of regulators. So we're taking measures both to help their clock speed by putting in place the sort of regular reporting that they impose on firms that they regulate. We'll put that on them themselves so that we can see as an industry, and there's a consultation on this at the moment, what are the right measures of success? How are we going to see that this new duty is being adhered to? And one of the things a lot of people will say is it's not even so much the actual regulatory outcomes, but it's the clock speed, right? It just takes a long time to list here, to get admission here, to be authorised here. How can we, in a competitive world, how can we just improve that clock speed?
Are you concerned when we see, say, as we saw in recent days, car manufacturers asking in some cases for renegotiations with the EU or with, say, the opposition talking about new relationship or, for that matter, obviously ongoing negotiations and talks over other matters with Brussels? Are you concerned that the freedom for the city and for financial services to innovate and diverge might be at risk of being traded away in return for other considerations?
No, that's not the approach. I mean, I think the Commissioner is over it. Well, she is over in the UK today. I'm seeing her tomorrow with the Chancellor. Look, what financial markets need, and that always sounds abstract, because it's what we all need. You want to invest in the best stories, the best companies, put our savings in a diverse place. What they abhor is friction. Right? And that friction could be by having a different set of rules to the European Union, our closest geographic neighbour, the US, the deepest and most liquid market in the world, or any of the other countries that we've now built and cemented relationships with. Switzerland is a really good example, a very similar, simpatico, internationally focused economy that we have a very close financial services dialogue with. And there's other emerging parts of the world. We have this great opportunity. The world has always looked to the UK. So if you're a growing economy and you're charting out your 2040 vision, and one of the things that you're looking at is creating a financial services sector, the first port of call is often to come over to the UK and talk to our high quality regulators and understand what have been the ingredients of success in the UK markets. And that should be a really good opportunity for us to try and shape the world in our own image, and by so doing, mean that we can trade or have relationships from a financial services sector with very little friction in them. So it's a long answer to the question is no, I'm not worried about that. This is actually a domain where probably a bit quietly and steadily we have got on and delivered, or in the process of delivering a lot of benefits from having our rule book back. A little bit less noise, I hope, a little bit more delivery. Something like Solvency II. Goodness me, I mean, you'd never think we'd be sitting on a stage talking about an actuarial accounting standard, but Solvency II, if we rewrite that particular rule for our own fact pattern is that we have prodigious amounts of private pensions capital. It's just not, in Europe they mostly had a social insurance model, so they were never as focused on Solvency II as we were. We can liberate, it's estimated, 100 billion of capital over the next 10 years to invest in all of the good things that people want us to invest in, social housing, the clean energy transformation, more risk capital, more science and innovation investment. And that's just one of the bigger ones, to be clear, but that's just one of the 30 Edinburgh reforms that we've talked about.
And on Solvency II, you say it's surprising. We'd be sitting talking. I've had a surprising number of conversations.
I find it surprising, and I'm an accountant. So.
In recent years about this.
Yeah.
On a political level, we know there is going to be an election coming relatively soon. I'm not going to press you on exactly when. But a lot of that election is going to come down to a debate about delivery for the Conservative Party. What you can see when you wake up in the morning, you go out on polling day, from your experience listening to the news you hear on the radio, the school you drop your kids off at, the streets and houses and factories that you walk past or don't on the way to the polling station, is there going to be a practical, visible effect in the economy from unlocking extra private investment in time for that election? Is that something the Prime Minister is going to be able to turn and point to?
I think on Solvency II, yes. I think you will start to see some of that capital be unleashed on that sort of time frame. I'm not an experienced politician, to be clear, but I suspect it's a combination, in truth, about the lived experience, which we're very clear as a government should be our focus, delivering that, but also values. And I talked, there are differences of values, and it's right people should form a view on that as well, because as Conservatives, we believe in a philosophy of individual choice. In financial services sector, we believe in risk and we believe in wealth creation. You only have to look at the reaction to an eminently sensible measure that actually previously got support from the Labour Health Secretary on removing the lifetime allowance on pensions. That was, in my head, that was a sensible measure, and it was a litmus test for, are we going to have a sensible pro-market, consensus here, or are people still going to be captured by the quite ideological politics of the past? I was quite disappointed and surprised by that, because this was something that is going to help doctors, vast parts of the public sector, and also had good benefits for society. We want people to stay in the workplace. We want people to put that capital, their pensions capital, to work in well-regulated, well-diversified, pretty low-cost investment vehicles, because that money goes somewhere, and you'll observe that commensurate with the pensions cap being introduced, we saw a huge expansion in buy-to-let, which has had really deleterious consequences for young people trying to get on the housing ladder. So to me, that capital, was much better deployed within the pensions, regulated space than it was being sprayed out in other places because of that unintended consequence of that policy.
Thank you. And a final one from me before we go to some questions from the audience. You talked earlier about democratisation. You called in your speech for SID to come back to the markets, for mass participation to grow in.
I mean, we're so far away from SID. I mean, there's probably no one in the audience who remembers SID, but it was a high point for people's connection with markets.
Yes, and he for those quite troubling number of people in the audience actually are far too young to remember that having happened. He was the advertising, the government's chosen advertising everyman figure for the idea of democratising markets, the property-owning democracy, when privatisation began. We've obviously seen a move away from that in recent years. Your own speech calling for him to come back suggests that there's a desire for that to grow. We talked a bit about the technological opportunities for easier participation. We hear, we see a lot of communication in the market about people being able to buy and sell shares and on their phones and so on. Democratisation of being able to put your money in is only one part of the deal of stockholding and buying shares, investing in companies. The other bit is meant to be having a say as a shareholder on the governance of a company. Yeah. And I think we can all think of a variety of occasions where even quite large institutional investors have felt that boards are perhaps not skilled enough, or oversight is not muscular enough, or executive capture can happen to major businesses. Are there things that government can do in order, or alternatively the industry should be doing, to empower individual personal investors, private investors, to have more of a say in the boardroom, to be heard as a collective voice through democratisation in capitalism.
Yes, I mean that was exactly what I was trying to say, just giving the sort of top notes, because it's a piece of work that's going on right now. So the first thing you have to do is to allow people to hold digitally. I mean, that's just a piece of great friction in the process, that it's so reliant on paper. So the Digitalisation Task Force, led by Douglas Flint, is working on that right now. We'll report back to the Chancellor and I relatively soon. And that'll put in place a roadmap to do that. Once you've been able to eliminate that piece of friction, and I suspect Hargreaves probably do a great job of this, others do, is if you're holding, most people will not hold directly. I mean, it's probably the right answer for most people is to hold via some sort of intermediary, whether it's in their ISA, whether it's a financial advisory firm. But good firms can still give people individual agency, because they can look at their holdings, invite them to have their say on corporate resolutions, and to do that for them. And that's what I want to push in to do. I think it'll be a good conversation. I also talked a little bit about some of the deficiencies of proxy agencies. I mean, the proxy agencies are relatively few. They themselves are not as transparent as they could be, and so often people will buy into a sustainability fund, but it's a little bit one size fits all. You're not actually sure what their stance is on some important debates. I think people should have choices, to be clear, but important debates about should they be investing in companies that are helping to bring peace to Ukraine? What's the role of nuclear? I mean, the environment movement's always been very split on nuclear. Many people say if we're going to achieve our clean energy transition goals, nuclear baseload is a really vital part of it. Is that properly reflected in some of the ESG policies that are out there?
Thank you. Now, I'm going to go to questions from the floor. There are a couple of house rules. Please first wait for the microphone to arrive. Please then say who you are and, if possible, where you're from. And third, please make sure it's an actual question. Otherwise, as I've always said before, I will boo you from the chair until you have to hand the microphone on to somebody else. Let's start here, please.
Thank you. James Kirkup from the Social Market Foundation and a few other places. Just a question about risk and politics for Andrew. I think a lot of people will probably be quite keen on what you say about shifting regulatory posture to allow investment professionals to take more risk and to deliver higher returns. But how do you take the public with you on that journey? I mean, in terms of retail politics, isn't there a chance you find yourself standing up saying to the public, we want to change the rules to make it easier for some fat cats in the city to take more risk with your money? Is that not going to be quite a tough sell with the public, particularly in the face of an opposition that might take a different approach and say, actually, we want rules to protect your money and protect you from risk? So how do you keep political support for that and take the public with you?
Thank you.
Yeah. That's why I want more of a debate about it, James. There's risk in the system. I think this is a highly literate and numerate audience, and we understand that you can't abstract risk. You can just move it around. So there is real risk today, right? There is risk that your savings and investments do not deliver the returns that will give you a prosperous long life and retirement, right? That risk is embedded. If everybody goes and decides that the thing to do is to put all of your savings into low-yielding gilts in an environment where we've had low interest rates because of just general monetary policy, and we've got inflation, then there's a consequence of that, and the consequence is you get poor slowly. That is a risk, but it's not always a risk that's talked about or litigated. We do need to have lucid conversations about risk in the media. One of the great challenges, we will make the UK a more competitive market for listings. All of the measures in place that we've got, actually some of the experiences of companies who have chosen to move their listings or list elsewhere is not that good. They become orphans, their aftermarket performance isn't that strong. But one of the things that is a factor is that the BBC Today programme only wants to ever come have a chief executive on and pillory them for, the wealth that they've created, some, market failure. I mean, we don't celebrate brilliant UK entrepreneurs and wealth creators. And, I'm always going to do that as part of my role people say you're the city minister. I mean, I'm happy to do that, but, the cities have to be across the whole of the UK. 2/3 of the jobs in the financial services sector and a huge part of the capital deployment is not in London. So it's not about being the City of London minister. It's, I always say the person I have in mind when we frame policy is someone living in a mid-terrace in Middlesbrough, right? I mean, that's where, that's where we need capital. That's where we need to build social infrastructure. And so we have to look at markets through their lens of how are we going to do that. The clean energy transition, unlike the transition of our lifetime, we started talking about digital. I mean, that was actually pretty capital light, right? That was all coding, it was software. The clean energy transition that we and other developed economies are going to go through requires prodigious amount of capital. If we're going to do that, and none of that, no one's building solar farms in the middle of London, right? They're going to be spread all over the UK. If we're going to do that, we need to deploy productive capital wisely, and that needs markets that actually work. So long answer, James, but let's be a little bit brave, right? Let's have the courage of our convictions, and let's talk about risk, not in terms of some abstraction as to what it means in the city, but in terms of what it means for actual people's outcomes. A better, more prosperous life because your capital is working well for you. That's how we should frame it, not in terms of the extremities of these debates.
Let's take two questions. Here and then here, please. Other side.
Over here.
Oh, there it is.
Chris Williams, based in Islington, ex-Young Conservatives, as you know. Andy, what is the basis of the government's apparent policy to make life hell for buy-to-let landlords to the effect of almost delegitimizing it as an investment model?
Thank you. And if you pass the microphone just back there, please, just behind you. Marvellous, thank you.
Thank you. Dempsey Best from Teneo. Questions on how do you think the UK can increase pension fund investment in productive growth assets?
I'm going to be good and duck the first one. I'm sure that the brilliant Con Home has similar seminars on the fraught issue of the housing market. I think from my perspective, good access to capital gives people the opportunity to be that. I mean, the products of the financial services industry are things we should be properly passionate about. The ability to pool risk with others, to improve the quality of your life, to build wealth either across different life stages or across different generations, and the ability to access credit, which lets people smooth out those really expensive moments in life, such as getting on the property ladder. But beyond that, I'm sorry, I'm gonna leave that one. In terms of productive capital, I mean, you're going to hear from the Minister for Pensions. So again, I'll try and stay in my lane. Look, overall, what we want is all capital to be productive and to have a very broad range of places to invest. The more that we can remove frictions, the more that we can. I mean, Solvency II is a good example just because it's one that's already well in flight that we're doing. I mean, there were simply restrictions in that detailed rule that said, even though you're deploying money for the very long term, you couldn't invest in assets that had a construction phase. So if you're building the world's most fabulously productive life sciences, laboratory or manufacturing centre, and it was going to produce, profits and revenues for 30 years, but the first 3 years you're building the thing, the current wording of Solvency II said that wasn't a legitimate investment for you. even though, in 27 of those 30 years, it was going to produce a really positive return, and overall it was going to produce a positive return. So removing any of those obstacles, where we consider it necessary, but we are conservative, so we don't start from, that every problem in the market needs a state intervention, but where we do observe that there might be parts of a funding curve where there aren't vehicles today, then again, we'll either look at removing the barriers. We've done that with, someone earlier mentioned LTAFs, long-term asset funds. There are now 4 of those. So that's a position where the government's come forward, worked with the industry, the regulators have authorised those, and now there's 4 new products that you can invest in, or potentially you can invest in, I'm not giving investment advice, that will allow individuals to have exposure directly or indirectly into those illiquid assets that would never have previously been the case. The Treasury at the moment is consulting, I think, with the business department on something called LIFTS, the long-term investment for technology and science. And that may be an example where the government's got a convening role, or even if, because we're willing to put money into that to sort of foster the creation of new vehicles. Another example is the UK Infrastructure Bank. So people talk a lot about, oh gosh, what are you doing about this, IRA thing? Well, actually we're a long way out the traps ahead of things like that. The UK Infrastructure Bank is mobilising 40 billion of capital into the clean energy economy and into infrastructure across the whole of the UK.
May I draw you for a moment on this housing question? I'm not going to ask you to tread on the toes of the Housing Minister or indeed the Pensions Minister, but you mentioned earlier the one symptom, for example, of one way in which people had chosen to use some of their pension early drawdown, for example, had been an expansion of money flowing into buy-to-let.
It was more, sorry, Mike, it was more, to be pedantic, it was more the fact that because of people's lifetime allowance and the chilling impact, not even of actually bumping up against it, but the thought that you might, dependent on uncertain investment performance, you did hear anecdotally, a lot of people that said, well, I'm not going to put my money into a pension, I'll go and buy a buy-to-let property outside of the pension wrapper, which was both inefficient for them, less liquid, less well-regulated, but also had that knock-on impact, in terms of potentially tying up some
Indeed.
part of the market. Sorry.
My apologies, you're absolutely right. And then you've just mentioned the way in which, say, improvements in questions like Solvency II can improve the opportunities for pension capital to be invested in various long-term and productive investments. Is it your feeling that when financial journalists are scratching their heads wondering why the UK invests its hopes as well as its money so much in the housing market, that's perhaps a little less about cultural tastes and a bit more about the distortion of poor regulation?
Well, I called out one particular distortion. That lifetime allowance, I believe, was distortive and it was damaging to, where capital would be more productively used. I don't know if I could be on a journey from that one, well understood example that I spent a lot of time studying to the generality. But capital is a wonderful thing, and you want it to, flow like, oxygen-carrying blood, around the whole of the economy. And where you do get structural rigidities, if banks can't lend to small businesses, I had an example the other day, if you want housing, banks are penalised for lending at the moment and potentially under a consultation of some other rules called Basel 3.1, getting all the lexicon today, but they're penalised for lending for custom and self-build homes. Now, I'm told the data says that actually as a cohort, they are very low risk. Perhaps you'd expect that because they're it's jolly hard, believe me, to try and find a site and build a custom and self-build home. So I suspect that the cohort that actually are using mortgage finance for those are highly vested and incentivised and actually a very low-risk pool. And that's something I've promised colleagues that as we look at the consultation, it's for the PRA to decide. It's not ministers can decide in a very binary way, but as the PRA looks at what are the potential lending rules, why would we want to penalise that if the data is saying that that's actually a good low quality, low risk type of lending. That's the thing about the financial, the rules in the financial sector. It's very important to calibrate them because they are very powerful in terms of their incentives and their ability to let that capital flow productively.
Absolutely. Now, two questions at the back, in the back row here.
Unkind observers may describe ESG as egregious socialist guff. How can we ensure that sustainable investment is not just about form filling?
Thank you. Brian Burns from Moneybox. You mentioned about ISA simplification and innovation. I wonder if you could shed some more light on that. I understand you probably can't give specifics, but direction of travel of what you would like to see in that space and potentially even timeframes. And secondly, could you give us some reassurance that you'll take a data-driven approach to that innovation from the likes of ourselves or Hargreaves Lansdown in terms of what we're actually seeing on a day-to-day basis in the ISA space, what's working and what isn't?
Data-driven 100%. Very keen that policy that we form is driven by data. My officials will attest to the fact that most subs come back with a request for the data, and testing and learning as well, right? I mean, I've got not an old-fashioned. I've got just a, perhaps a business-focused approach to how you form policy. It's not all tablets on stone handed down on high, for all time. We should look to innovate. And as I was at pains to point out, there's lots of really, really good things about ISAs. So meddle at your peril, but we've seen a few trends, and simplicity. Someone who spent 20 years in effectively a consumer marketing business, if you're trying to broaden the reach of something, and that's the objective, is to get more people to have access to these brilliant vehicles, then you've got to be able to market it. You've got to be able to encapsulate the benefits of it in a very simple conversation. So it's become a little bit complex, a little bit cluttered. On one level, I'm very sympathetic to that, but to your point, we've also got to be data-led. So there's a consultation going on. Please feed in, and let's see how we can make it work. It also goes hand in hand with what they call the advice guidance boundary, because we've, through unintended regulatory consequence, we've lifted the ability to go and consult a financial advisor. It's effectively out of the means of most people, and that's what that advice guidance boundary debate is about. And again, I'm seized of that, and that's where the data will go. I hadn't heard that. I genuinely hadn't heard that. I'm not sure I'll be using that. But look, we believe in choice. So what I don't want is a sort of a chilling consensus that all investment has to be managed against a particular framework, and that framework itself isn't as transparent. Beyond that, people should make literate choices and understand. So there's absolutely a role for some extreme vegan fund if that's what somebody wants, but also people should have the ability to have different managers managing against a different mandate. And I think it's just one of those things. It's exploded massively. The amount of money managed against an ESG mandate is really, really significant. The UK has a strong position in that, so it's good, right? It's good. Lots of bright people, deciding what those mandates are and things. But there isn't a single set of data standards against which to measure them. And I would just like us to surface and oxygenate the debate about what's your form of, quotes, ESG versus what might be mine or a third party. So people have that informed choices. Good conservative principle, informed choices. If you've properly been informed of what those choices are, if you've accepted those risks, then we allow you to go forward and take those, but then you don't come back against the state afterwards and try and relitigate that bargain.
a good and topical summation on which to finish. Now, ladies and gentlemen, we started a few minutes late. I'm trying to drag us back a little bit onto time, so I've given you a couple of minutes extra. I hope you'll join me in thanking Andrew Griffith, the Economic Secretary for Treasury.
Thank you very much.
Thank you very much.
I've got it. Another photo.
And we'll be back in a few minutes for our next